amortization rules is to keep people from carried away by, as you say, the greed of expecting to become rich by buying a home and reselling it at a higher price.
And that's important. If one of the barriers to home ownership is the inability to make a down payment, and if one of the goals is to increase home ownership, it makes sense to help people pay that down payment.
This is the problem, the moral hazard. We gave a moral hazard to home buyers. Once you say that you can buy a home with no down payment, all of a sudden there's no risk to the borrower. He doesn't care if he overpays, because if the house keeps going up, he makes money. If it stops going up, the bank loses the money. You know, we have moral hazards in our banking system. The U.S. government guarantees all bank deposits. Well, what does that mean? That means that depositors don't care what the banks do with their money once they deposit it, because they know the government guarantees it.
And the federal government obviously has to play an important role, and we will. We will. I mean, when I lay out a goal, I mean it.
Why are they doing that? Why can't we let mortgages be financed in the private sector? The reason is because the private sector would not finance these crazy mortgages, and real estate prices would have to come down to levels that people can actually afford.
How can you promote home ownership if people can't afford the home?
The big banks dared to make riskier loans because they had started repackaging loans and selling them to others as securities. They sold them to each other, to Fannie Mae and Freddie Mac, and they sold them to Norway, to Germany, and to China. If the loans turned bad, someone else would end up with a hot potato.
I guess we're a little early. What do you want to do?
Anything but inspect this temple of capitalism.
Oh, Nick.
Look at them. Their eyes popping out of their heads, drooling over the very things that are taking away their jobs.
Now, Nick, don't get all excited. My family think that America is a pretty swell place, and I don't want you to disillusion them.
I know.
Everybody wanted to buy because the rating agencies that rate securities gave the mortgage-backed bonds their highest rating. They promised huge payoffs at near zero risk. The rating agencies thought that house prices would just keep rising. And then there was that minor detail that the rating agencies were being paid by the sellers of the securities.
And I think the process was corrupted. First of all, the government licenses Moody's and Standard & Poor's. So there's only a few companies who are authorized to rate these bonds. So it wasn't really a free market. The government was in bed with Moody's and with Standard & Poor's. But also you had this perverse relationship between Wall Street and the rating agencies, where they were paying the rating agencies to rate the products that they were structuring. And so there was, this was an incestuous relationship where they knew if they put bad ratings on them, they wouldn't sell. And if they didn't sell, they wouldn't be making all this money constantly rating them.
They were great days, but it was all based on a market on steroids. Loans were cheap enough to keep driving housing prices up. But when interest rates returned to normal levels in 2006, the spell was broken. But for one person, the future was still bright. Ben Bernanke, Alan Greenspan's successor as Federal Reserve Chairman.
Tell me, what is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis.
People could no longer get new loans to pay off the old ones. Those who had been given a mortgage despite a very low income couldn't afford to stay. The prices started falling, making the mortgage-backed securities increasingly worthless.
There's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy.
The rating agencies removed the high ratings from the securities. Investors who never looked beyond the ratings suddenly didn't know what they had bought. They didn't know how risky those loans were.
Overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008 to a rate close to the economy's underlying trend.
The dominoes started falling. Investors stopped buying mortgage-backed securities and refused to lend to those who depended on them. Investment banks like Bear Stearns and Lehman Brothers suddenly couldn't get new loans to stay in business. Fannie Mae and Freddie Mac could no longer hide the disaster. The financial crisis started in a way that is eerily similar to today's situation. It started with an economic crisis in the US and a government that responded decisively. After 9/11 and the dot-com collapse, the US government decided to save the economy by inflating a new bubble. Today, the world is trying to get out of the financial crisis by inflating a new bubble. The difference is that this bubble is much bigger.
After they did the dot-com bubble, and that burst, and they reinflated it with the real estate and credit crisis bubble, and then when that burst, now they've created the bubble of all bubbles. And it's not only the United States, this is a global bubble. They're all into it. It's called the bailout bubble. Hey, the economy's going down, recession's setting in, sales don't look good, exports soft, need more money? How about, we'll call it stimulus packages. And from Australia to the United States, from the UK to China, they're dumping funny money into the system to keep it going.
In September of 2008, the US economy is near collapse. Fannie Mae and Freddie Mac have been taken over by the government. On September 15th, giant investment bank Lehman Brothers goes bankrupt after monumental bets on real estate. AIG, the largest insurance company in the world, collapses the next day. Fear sets in. It seems like anyone can fail. Suddenly, banks no longer dare make loans to companies or each other. Experts warn that the economy is about to collapse.
This CBS News special report, a presidential address to the nation. From CBS News headquarters in New York, here is Katie Couric.
Good evening, everyone. President Bush asked the networks for this television time so he could talk directly to you about a national crisis. Some of this country's major financial institutions are in danger of collapsing under the weight of bad mortgages, and that would be devastating for the entire economy.
We are in the midst of a serious financial crisis, and the federal government is responding with decisive action.
In a televised speech, Bush scares the market even more, while still claiming that they can trust him. He has a solution.
Under our proposal, the federal government would put up to $700 billion taxpayer dollars on the line to purchase troubled assets that are clogging the financial system.
The US government wants to spend huge amount on Wall Street banks to cover their bad deals. Even banks who don't want the money will be forced to take it, so that the public won't know which banks are on the brink of collapse.
All those in favor say aye. Opposed say no. The ayes have it. Speaker.
I want to thank the Secretary of the Treasury for working hard with the members. I thank the members for working long hours like they've been doing to come up with a solution that's bipartisan and that'll solve the problem.
On October 3rd, Congress approves the biggest financial bailout in history. $700 billion. Around the world, in Germany, Italy, Canada, South Korea and Great Britain, other politicians do the same to save their banks.
We've taken the right, the decisive and the tough decision that was necessary to protect the stability of the financial system and to protect the depositors.
David Walker was US Comptroller General from 1998 to 2008. He quit because he was so worried about the US economy that he wanted to have the freedom to warn about what may happen.
In my view, the bailout was necessary in certain regards, but in many cases we wasted a lot of money because we didn't do three things. First, have clearly defined objectives about what we were trying to achieve. Secondly, have criteria established up front as to who would get the money and who wouldn't get the money. And number three, have conditions established up front as to what they could and couldn't do with the money. And as a result of not having those three things, some people got the money that didn't deserve it. Other people got the money that didn't make good use of it. And as a result, we had a lot of waste with regard to taxpayer money.
What would it mean if the domestic industry were allowed to fail? You heard Senator Stabenow, so I won't repeat other than to say...
As a result of the crisis, the situation for the U.S. auto industry became critical. On November 19th, their CEOs fly to Washington to demand money.
The executives came out and they said, if you don't do this, we are going to see a jobs holocaust. They issued extremely high estimates of how many jobs would be lost that included counting every single company that supplies them with anything.
That's why this is all about a lot more than just Detroit. It's about saving the U.S. economy from a catastrophic collapse.
A month later, President Bush gives billions of dollars to General Motors and Chrysler. The money comes from the bailout package that was really only designed to save the financial industry.
Now some U.S. auto executives say that their companies are nearing collapse, and that the only way they can buy time to restructure is with help from the federal government.
Megan McArdle is a financial analyst for The Atlantic and has written extensively about the problems of the U.S. auto industry.
Congress wanted an excuse to bail out the auto workers, and the executives gave them just enough political cover to say, well, I'm not really doing this because I want auto worker votes and I'm going to give them a huge amount of money. I'm really doing this for the American economy. But if you look at how much money we gave them, I mean, you're talking about almost $100 billion is how much we will end up spending on this. You know, even if you were saving millions of jobs, it would have been cheaper to give every single one of those people $100,000 to go out and, find a new job.
The big guys on Wall Street, they can't take their losses. They're crybaby capitalists. Oh, they preach capitalism for everybody but themselves.
The Federal Reserve has cut its key interest rate to the lowest level on record. Fed Chairman Ben Bernanke and his colleagues also pledged to use all available tools to contain the widening crisis and the longest recession in a quarter century.
December 16th, 2008. It is time again to pour alcohol